the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. The Singdollar has strengthened 6 to 7% against a weakening US dollar in 2025, marking its strongest year-to-date performance in the last 20 years. Now, as the Singdollar gains strength, questions arise about whether it can sustain this momentum and ultimately reach parity with the US dollar, a milestone that could have wide-reaching implications for Singapore's economy, exporters, importers, and investors alike. What are the key drivers behind the surge in the Sing dollar's value, and how much of this movement is tied to the US dollar's weakness, and how much stems from Singapore's own economic fundamentals? How soon can we see 1 USD equaling 1 SGD? Well, to find out more, joining me now is Gan Jing Kai, who is a dealer for a contract for differences at PhillipCapital. Jing Kai, welcome to the show.
Hi, pleasure to be here too.
Thank you so much for joining us, Jing Kai. How is the USD SGD pair faring at the moment?
So the current recent trend shows that the Sing dollar is appreciating against the US dollar. So last year, the US dollar traded strongly in the high 1.3s against the Sing dollar, particularly after the US elections. The pair briefly dropped when the current US president took office, but soon climbed back to above 1.3 again. As of June 2025, the exchange rate has shifted to the high 1.2s, reflecting a 6 to 7% depreciation of the US dollar relative to the Sing dollar. So among the catalysts for the pair's breakdown trend was the Liberation Day, as we see the reciprocal tariffs back in April. So although Singapore is one of the countries with the lowest reciprocal tax rates, tariffs are still not beneficial for international trade. But we also see the investment sentiment towards the US dollar has been tempered over concerns of US fiscal issues. Meanwhile, Singapore's consistent trade surplus, our stable fiscal management, and also foreign portfolio inflows into local equities have supported the Sing dollar's relative strength, contributing to the current exchange rate we are seeing right now.
Okay, so what does the current trend in the USD SGD exchange rate tell us about the strength of both economies?
So if we compare both recent indicators for both the US and the Singapore, in the US, unemployment has risen from 4% back in Jan to 4.2% in April. So jobless claims are also increasing. We see that the Feds are expecting further softening of trade amidst the uncertainty and also slowing growth. We also GDP contracting 0.2% last quarter. And also we see that firms are being cautious on hiring and investment. Meanwhile, in Singapore, unemployment rose slightly to 2.1% and also GDP contracted by 0.6%. Quarter on quarter. But if you look at year-on-year growth in manufacturing, it has helped us cushion and slow down a lot, offering a degree of stability among our external challenges that we face. With that said, also, local business sentiment itself is cooling, and we also see that the government has also downgraded its economic growth forecast to 0.0 to 2% this year.
Okay.
So overall, the movement of the exchange rate shows that the economic situation in both countries, we can see that Singapore's economy, relatively speaking, is doing slightly better than the US.
Well, on that note then, Jing Kai, how do Singaporean investors typically perceive the strength of the Sing dollar compared to the US dollar, and how does this shape their investment decisions?
So I think a stronger Sing dollar means that investors made US dollars are now worth lesser when you convert back. Also, many investors look into the US capital market, so I think the Sing dollar US dollar rate becomes an important consideration. For example, if you have invested in the S&P 500 at the start of the year when it was around 5,009, and currently we just recently broke the 6,000 mark, so your portfolio may appear to have a small gain in US dollar terms, but when we convert back to Sing dollars, you see the effect of FX loss around 5 to 6%. So just say US dollar as a safe haven itself. We also see that the recent downgrade in the US credit rating by Moody's could also raise borrowing costs for the US government. So if you see that there's a higher risk itself, which means investors also demand higher return. So a lower credit rating itself will affect the perception of US assets as truly safe. So, but then we can also see that this downgrade hasn't really rattled the markets the way that the S&P did back in 2011, where the S&P fell actually 6.6% in one day. So, but for local investors itself, I think it's worth looking at companies that have a significant exposure to US dollar itself. So a weaker US dollar would reduce the revenue when we convert back to Sing dollars, but also it lowers the cost of imports. So given that Singapore's value-added trade model, so we import goods, we enhance them, we resell them. So this FX dynamic could actually improve profit margins. So this often actually show up in earning surprises. So some investors can actually look out for that.
Okay. Well, some analysts say parity between the two currencies is possible in the future. So given current global economic trends, is it realistic for the Singdollar to reach parity with the US dollar within our lifetime? I mean, what would need to happen for that to occur?
So I think reaching parity with the US dollar is a bit highly improbable in the near future. So the lowest we see that the US dollar Singdollar has been was around 1.19, 1.2 back in 2011. And for the pair to reach a 1-to-1, you require another 17% drop from there. So a move that is likely to occur only when there's a major structural shock in either US or Singapore's economy. So which is currently not foreseeable. But if you look at both backgrounds of economy itself, the structure of the economy, the US is built on that. So a strong US dollar will support their system by maintaining a global demand for the currency. So but currently they have efforts to have onshore manufacturing. These shifts are long-term and also face a lot of structural hurdles itself. So in contrast, Singapore is a net exporter with a positive trade balance. So a stronger Singdollar itself, especially at parity, will really erode our export competitiveness, especially even though our goods are not highly price sensitive, but it's really a 20% rise in the Singdollar will really push export prices to unsustained levels.
So would a weakening USD or a significantly strengthening SGD be the more likely path to parity?
So we never really get close to parity. I think it's more likely due to the weakening US dollar. So if the USD consider that they face persistent fiscal deficits and also there's a declining demand for their treasuries and everyone else going towards currency diversification. So I think these factors itself will really erode the long-term confidence in the dollar itself. And if you look at constraints on like Singdollar appreciation, mentioned previously, we are really reliant on exports. So I think MAS will not be really allow it to happen to such a significant sharp appreciation. So stronger Singdollar will reduce our export competitiveness. It really hurt our key sectors like manufacturing and logistics. So I think MAS managed float regime itself is designed to prevent this kind of excessive appreciation and to maintain economic stability.
Would MAS, though, allow the Singdollar to appreciate, that much? I mean, are there any policy limits or interventions that would prevent it from reaching parity?
So if the Singdollar appreciation will really go towards parity, I think MAS will likely intervene to slow down or at least to reverse the move. So this significant rise will really undermine our export competitiveness. And also MAS manages the Singdollar with an eye to inflation and also economic output, not really an arbitrary level like a parity. So in the latest policy stance, I think MAS has also allowed for a slightly slower pace of appreciation to support our growth. But at the same time, they have a threshold to prevent the Singdollar from getting too strong.
All right, makes sense. Well, what would be the implications for FX markets and investor portfolios if, let's say, SGD were to reach parity with USD?
Okay, so I think a 1-to-1 exchange rate between US dollar and Singdollar would really be a signal for a major shift in the global economic dynamics itself. So if you look at the impact on global economy, such a fundamental change will likely bring about new risks. So a lot of countries may respond with protectionism measures or actually currency interventions because to protect their own trade itself or to protect their own manufacturing landscape itself. So the impact on retail investors, so we don't really typically hedge our FX risk. So we may experience direct currency losses on our USD investments, especially when the Singdollar strengthens sharply when you convert back. Usually we wait out for FX to rebound, which is a very common thing that I see. That also involves opportunity costs, and also there's no guarantee that there's a recovery on FX itself. So to offset these kind of losses, I think the required rate of return on your US dollar investments must exceed the FX drag. On the flip side, if you're just starting to invest, a stronger Singdollar means that you have actually increased purchasing power for the US dollar itself.
I mean, you mentioned that the parity between the two pairs may not be, achievable soon, but are there any investors already preparing for this possible future of parity between the two currencies? If so, what are some of the strategies that investors are using in regards to the pair?
So, this 1-to-1 is hypothetical itself. I think most of retail and institutional investors are not really prepared for such an outcome because it's really unlikely. So rather than speculating on parity, I think what investors are focusing on right now is managing their FX volatility itself. So instead of like the current US monetary policy, the geopolitical tensions itself, I think one way is that people are actually in fact hedging their FX risk in short-term ways. So for example, like ETFs or currency hedged ETFs or Asian CFDs, options, futures. But with that said also, FX forwards and options, these kind of derivatives are not generally easily accessible to retail investors, as it may be also unnecessary when their portfolio are smaller.
Well, also in a hypothetical situation here, if the SGD were to reach parity with the USD or even close to parity here, how would this impact Singaporeans, or how would this impact Singapore's trade competitiveness given its export-reliant economy?
So I think that the direct effect would be a stronger Singdollar would hurt our exports competitiveness since we are really heavily reliant on exports. And also exporters would face a serious price disadvantage in the global markets if we were to reach parity. So goods priced in Sing dollars will become more expensive relative to our neighboring countries itself. But then if you look at industries at risk, then most of the industries that are on tighter margins and also more sensitive to global price, such as like semiconductors, pharmaceuticals, logistics services, will also be affected. So these sectors itself thrive on cost competitiveness, and a much stronger Sing dollar could really prompt like the multinational corporates to actually relocate to their manufacturing operations to overseas with a more favorable exchange rate itself. So while overlooked itself, our Singapore's financial and professional service sectors are also one of the major exports. I think that a stronger Sing dollar itself could make the cost of legal, fintech and consultancy services actually less attractive to our regional clients, especially those from the emerging Asian market.
Okay. And I believe a lot of people would love to know, if the SGD were to reach parity with USD, how would this impact Singaporeans' purchasing power abroad?
Yeah, I think at parity itself, each Singapore dollar will actually buy $1. So Singaporeans who really want to travel to the US would have cheaper travel expenses, accommodation, dining, shopping, but only in the US, as exchange rate between the Sing dollar and the US is affected. But we are assuming that other countries not affected against the Sing dollar. So we're assuming that the US dollar weakens.
Okay. Well, how can financial advisors, support investors then in navigating currency volatility and positioning their portfolios for long-term resilience, even amidst FX market shifts?
I think financial advisors can recommend methods and I think educate their investors on FX risks and ways to mitigate them. So I think the direct approach is to hedge FX using derivatives. So one of the form of the risk that we discussed along just now was that the change in the fundamentals in the country, if there is a parity. So in light of building a resilient portfolio itself, I think we need to reevaluate the asset allocation strategies when these kind of economic environment do change. So regardless of the Sing dollar really going into parity with the US, financial advisors also can take a more proactive approach in understanding like the recent world changes or world events, such as, because FX volatility always exists. So I think it's a good thing to equip yourself with knowledge to better serve your clients. So approaching your clients with this kind of mindset to help them is a way to care and help them to achieve their investment goals.
Well, to wrap up our conversation here, Jing Kai, what do current FX models or forecasts suggest about the long-term trends in the SGD and USD?
So the long-term forecast generally itself indicate that the Singapore dollar will experience some moderate appreciation against the US dollar, so reflecting our current strong fiscal position and also the steady current account surpluses. But most forecasts anticipate a gradually also weakening US dollar due to the structural issues right now they are facing. However, the dollar's role as a global reserve currency and also the safe haven is slowly declining and also is a bit uneven, where the US dollar is maintaining some significant influence. It still maintains their influence in international trade. And also, I think you see that at parity itself, most economic models and financial institutions will not really think that the parity will reach anytime soon. So for such a scenario, really require really extraordinary shifts in economic fundamentals or even policy frameworks. So instead, I think forecasts should suggest that the exchange rate will continue to fluctuate within a moderate range, influenced by a few factors such as interest rate differential, also our trade balances.
All right. Well, thank you so much, Jing Kai, for your time and your insights today.
Thank you.
Thank you. That was Gan Jing Kai, who is a dealer for contract for differences at PhillipCapital. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.